How about that? All right, guys. Are we good to go? Are we a little early? What's going on, everybody? We're gonna have some fun today. I see we got everybody's coming in. We'll give everybody another couple of minutes. I accidentally hit the start button, amateur hour over here. Can you guys, let me just pop out the question. All right, can you guys do me a favor? Can I get a yes and a yes if you can both hear me and see my screen? Let's start with that. Neil says, yup. All right. So I get a yeses and yeses. Steven. All right. So you can see, all right, the construction of the 2 to 100 club. Sweet. We're going to have a good time, guys. I already had dinner tonight, so now I'm just chilling. We're going to talk about some cool stuff. We're going to give everybody another couple of minutes. But how's everybody doing in the market? Good day in the market today or what? You guys hanging in there in this environment? What do you think? Fire them over there. Let me know what you guys think. Any just thoughts? Just, right off the bat. One of the things I really like to do sometimes is, turn my phone off, kind of step away, just get a notepad and a pen and just start writing things down. Just start writing ideas down. What's on my mind. Really helps me think through that. Just get a notepad. Old school. The kids these days are like, you got a what? You need to get a pencil or a pen? Kids these days, they don't understand. They don't know the struggle back in the day. Pen running out of ink and whatnot. Yep, Jill says great market. George wants to ride the pony. Ride the pony. Sounds like a bull market sort of commentary there, right? You don't hear that sort of thing in bear markets, right, George? Sukar says volatile. Whoa. So if you think this is volatile, whew, you ain't seen nothing. So what, we got the VIX at 20. This is, we've seen some more volatility, that's for sure. Coming crash of 2021, another crash. So once in a generation crash happening a year later, right? Once in a generation. How do we answer questions? I don't know. Do I have any questions? I haven't asked any questions yet. All right, so let's see. We got another minute. Before we get going. So what else is going on? Good market? You guys happy? You guys making money or what? A lot of sector rotation going on. Very interesting stuff. Very, very interesting, I think. All right, so we'll get going now. All right, so we're recording. All right, great. So everybody, welcome to the 2 to 100 webinar. I'm going to show you guys how and why, for that matter, we construct what we like to call the 2 to 100 club. And these are the stocks that we think are going to be the next $100 billion companies, right? That's what we're looking for here. And then we're going to overlay our technical analysis to find the best risk versus reward opportunities to take advantage of these particular situations. So get excited. This is, for me, we're not supposed, how you're not supposed to say like which one is like your favorite kid, right? Like you're all supposed to love them all the same. And internally, like we're supposed to, like, as far as our research is concerned, we're supposed to talk about them like, we love them all. These are all great value. But the truth is, like, this is our favorite universe that we put together. So, full disclosure. Before we were kind of like shy about saying that, like maybe we shouldn't say that. And now after a while, it's like, yeah, it's our favorite. Just own it. Whatever. All right, let's get going. So I'm JC Parets. That's me. Some of you guys might know me. I'm going to shut off the camera here. I'm going to focus on the screen here. Let's shut this camera off for a second. Stop sharing webcam. Boom. All right. So, guys, my name is JC Parets. I'm a chartered market technician. I am incredibly fortunate to be probably the most widely followed technical analyst of all time. And, simply as a function of, social media and the fact that I've traveled and been invited to speak all over Singapore, Hong Kong, Taiwan, Philippines, Malaysia, and Kuala Lumpur, all over Europe, Dublin, Amsterdam, London, obviously, Paris, Athens. Such amazing opportunities that I've had to meet with investors, meet with clients, meet with partners out there, give presentations, some at charity events. Mumbai. I've been to India multiple times, 4 times last I checked. Tokyo, all over North America. Your usual suspects: New York, Chicago, Miami, San Francisco, Vancouver, Toronto, Dallas, right? Like all your standard places. And what's great about that is that for me, as you're going to see throughout this presentation, for me, it's easy. Like I can sit there talking about my charts. I mean, I literally do it all day, every day, whether I'm talking with clients or partners or, internally in my own firm that I own, right? So I am the founder of allstarcharts.com, and I provide assistance, if you will, guidance, if you will, to pretty much every major bank that you've ever heard of, and a lot of the major hedge funds, household names. Obviously, I can't say who my clients are, but you know who they are. You're very familiar with who they are, and they pay me and everything, and that's great, and I'm happy to take their money, obviously. But the truth is, I'm the one learning. They're asking me questions. I'm asking questions right back. The information they're giving me a ton of data. Literally, our clients are, and colleagues and partners for that matter, are handing us data. They're like, JC, this is better in your hands than it is in my hands. So why don't you guys dive into it and let me know what's in there? To the point where we had to build a supercomputer. I don't know what a RAM is. That's the truth. I don't know what it is. I don't know what a RAM is. But I have so many of these RAMs for a supercomputer, and I know that they're not cheap. So that's my world. And what I do for fun, I'm also a certified sommelier. So for those of you who are interested in wine, I myself, I do this stuff for fun. For me, it's an academic endeavor, and the IRS lets me write off my booze. So that's a nice little life hack I got going there. So that's a little bit about me. Just recently got, if I don't mention, I just got married last year. Beautiful little 4-month baby girl. And that's really, at the end of the day, the most important part of my life. All right. So, okay. Got that out of the way. You guys who maybe follow the financial media, maybe have seen me. I'm quoted pretty regularly across the board. CNBC, Bloomberg, Wall Street Journal, of course, CNN, and others not listed here. But this has also been a great experience for me to understand the way the media works, the conflicts of interest, what they're trying to accomplish versus what investors are trying to accomplish. So the amount of television hours I've put in has really, really helped me understand the way things work, the way investors are thinking. And there's just a huge arbitrage there to take advantage of for sure. Big ups to the team. It's not just me, it's the whole team. In the Technical Analyst Awards last year, we won actually for Best Fixed Income for our award-winning research. And we were also finalists for Best Equities, Best Multi-Asset Research, and I was a finalist for Technical Analyst of the Year. I didn't win, but I got a shout out as one of the 4 finalists. So that was pretty cool. My good buddy Ari Wald won Technical Analyst of the Year. He's the man. He's at Oppenheimer. All right, so what are we going to learn today? We're going to learn how we use a series of universes of stocks to supplement the top-down work that we're doing. And what does that mean, that top-down work? What does that mean, supplementing the top-down work with these universes? Well, we're going to get into that. And make sure you stay till the end, because I have my favorite trade. We just dropped the 2 to 100 club, the latest 2 to 100 club. This is just a coincidence that we're doing this webinar the day that the 2 to 100 club is released. In fact, I didn't even realize that until earlier today, where I was like, oh, we're going to do a 2 to 100 webinar, and we're actually dropping it today. So I wish I could tell you how smart I was to have planned that, but that actually was just a big coincidence. So we're going to have a trade coming from the 2 to 100 club at the end of the webinar, so make sure to stay till the end. Okay. So, JC, what is, let's show the webcam so you guys can look at my eyes so you can really see what I'm talking about. Okay. What is the top-down approach? The top-down approach means that we want to look at stocks as an asset class. Not just stocks in the United States or stocks in Canada or stocks in India, wherever we might live. We're looking at stocks as an asset class. So we basically want to stand on the moon, pretend anyway, stand on the moon and look at Earth and look at stocks all over the world, not just in the United States. That's the first thing we want to do. Are more of these countries going up, or are more of them going down? Are more of these countries breaking out of bases to new highs, or are they resolving tops and breaking down to new lows, right? We're going country by country, emerging markets and developed markets, Europe, Asia, Latin America, Africa, everything in between, right? It's the first thing we do. Then we're going to do the same thing for all of the commodity futures, and not just gold and silver and oil and natural gas, but everything in between, from wheat and corn and soybeans to cardamom futures in India and palm oil futures in Malaysia, right? If there's a futures contract, it's probably on our list, right? So we're going to do the same thing. Which ones are going up? Are the energies going up? Are the metals going up? Are the agricultures going up? Are they going down? Are they not doing anything? What's going on in the commodity space? Then we'll do the same thing for the Forex markets, basically the top 60 crosses, and not just euro, yen, Aussie, CAD, and British pounds and dollars, but also Naki, Saki, and everything in between, right? So about 60 of the top currency crosses to really see that money flow. And of course, the interest rate markets across the globe, probably the 30 most important markets. We're looking at the yield curves and the interest rate markets across the curve. So we could really get a multi-asset class perspective, and that's the intermarket relationships that we are doing. We are going one by one, and we're looking at all of these asset classes, and then we are comparing them to each other. That's what we call intermarket analysis, like stocks versus gold, stocks versus bonds, silver versus small caps, right? These are intermarket relationships that we're looking at. Interest rates, for example, which we're going to look at in a minute, move with the copper gold ratio. The copper gold ratio and US 10-year yield move tick for tick, right? So those are the intermarket relationships that we're looking at. Fine. So then we do all that stuff. And then once we've accomplished that intermarket global macro perspective and we've identified what the trends are, then we'll get to our country of choice. In today's conversation, because I have clients all over the world, so maybe we're in Singapore today, or maybe we're in London. Today, we're having a conversation about the US stock market. So we're going to do all that analysis first, regardless of what country we're focused on. Today, we're focused on the US, so what are we going to do? Now we're going to look at all the US markets. S&P, Dow, Nasdaq, Russell 2000, mid-caps, all of them. New York Stock Exchange Composite, the value line, the Dow Composite, the S&P 1500, the Wilshire 5000, one by one, all of them, right? It's a long, long list. The Momentum Index, the IPO Index, all of those, right? Okay. Then, once we identify, are all of them going up? Are some of them going up and not the other ones? Where are the divergences? Are there divergences? Then we're going to do the same thing for the U.S. sectors. And depending on who you ask, we have 11 or 12 different sectors. Technology, healthcare, financials, energy, right? You know them all. Those are the sectors. But within the sectors, you have specific industry groups, which are also going to be included in our analysis. Again, that trend identification analysis that we're doing. And what does that mean, these industry groups? Well, in financials, for example, we have financials as a sector. But then within financials, you've got broker dealers, you have regional banks, you have insurance stocks, all different asset managers, all different kinds of types of financials. Within healthcare, for example, you've got biotech, you've got pharmaceutical, managed health, you've got medical equipment stocks. Medical equipment stocks are robots that are performing surgery. This is technology. What does that have to do about you, right? So there's vastly different sectors. Look at energy. Within energy, you've got explorers and producers. You've got the refiners. You've got the oil services. You've got solar stocks. You've got all sorts of different things going on in energy. So I think it's not only important to identify the trends at the sector level, but also at the industry group level as well. And then finally, we're going to analyze the components of those groups. So by the time we decide that we're going to buy Abbott Labs, 95% of the reason we're buying Abbott Labs has nothing to do with the chart of Abbott Labs. It's probably because we like stocks as an asset class. We like stocks in the US. We probably like healthcare. We probably like large caps. Within that, medical equipment is probably showing a relative strength. And therefore, Abbott Labs versus maybe Medtronic offers the best risk versus reward opportunity to express a bullish thesis in medical devices and healthcare in US large cap for that matter, right? So that's the thought process of the top-down approach, where when we decide on a stock, there's a lot more to it than what's going on in that. It's not because it crossed above a stupid moving average. It has nothing to do with that, right? It's everything else that came before that. So that's the top-down approach. And I think it's important to express that and to explain that so you understand just how important it is for us to create the bottoms-up universes of stocks. Today, we're focused on the 2 to 100. I'll touch on a few other universes, but today we're focused on the 2 to 100 that, for me, is such an amazing supplement to the work that we're already doing from the top down. All right. So why don't we go into the top-down approach and walk through sort of what happened earlier this year, right? So let's do like a case study. And I've said it before and I'll say it again. I'm not afraid to say it. The stock market crash in February and March came after more warning signs than any stock market crash in history, right? And I'm okay saying that, right? And not because we knew. I mean, I was on TV, I was on Bloomberg talking about short stocks, sell stocks, buy bonds. You know, I was very vocal about it. Like it wasn't a secret. It has nothing to do with that. It's more to do with the fact that there were so many factors suggesting get out of stocks. Not necessarily that a crash was coming. I didn't know a crash was coming. I just knew enough that we didn't want to own stocks because the risk was too high, right? And we wanted to own bonds instead. Okay, now let's figure out why. All right. So first of all, let me pop this out. Okay. So first of all, here we're looking at a chart of the U.S. Treasury bonds versus the Nasdaq, right? So the bonds as a numerator, Nasdaq as the denominator. We use the Nasdaq because they're the strongest stocks in the United States, in the world for that matter. So okay. So what's going on here? So as this chart is falling, that means bonds are underperforming stocks. As the chart is rising, that means bonds are outperforming stocks. So notice how at the beginning of the fourth quarter of 2018, this ratio started to rise. That means bonds were outperforming stocks. If you recall, stocks were getting killed in the fourth quarter of 2018. Fine. Markets did okay. Now here we are back to the scene of the crime. This is at the end of January of this year. And we're like, man, if bonds are ever going to start to outperform stocks, this would be a perfectly logical place for it to do so, right? It's the same place where it started to outperform last time. All right. So now I'm looking at U.S. interest rates and I'm saying, okay, we have a low in rates in 2012, again in 2016. We retested again at the end of last year. Man, the more times the level is tested, the higher the likelihood that it's going to break. So, man, I don't want to be betting that we're just going to hold. So if rates collapse and bonds start ripping, is the stock market most likely under pressure in that environment, or is the stock market probably doing well? My bet is if interest rates are collapsing, stocks are probably under a lot of pressure. Meanwhile, when we look at the intermarket relationships, here are regional banks versus REITs. Here's copper gold ratio. Here's the U.S. 10-year yield. Notice how all three look exactly the same, right? So U.S. interest rates are breaking down. Commodities are confirming that. Stocks are confirming that as well, pointing to lower rates, higher bonds, okay? Meanwhile, this is still at the end of January. The S&P 500 is hitting our target. This is the extension from this consolidation. So bonds are saying that we should be buying bonds and selling stocks. Meanwhile, the S&P 500 is hitting our upside objectives. This is at the end of January. And the global 100 index is hitting our upside objectives, right? Our Fibonacci extensions, right? These were our targets, right? So global markets hitting our targets, local markets hitting our targets, and bonds relative to stocks are bottoming out. Okay, that's interesting. Meanwhile, from a risk aversion standpoint, when money is getting out of risk, where is it going to go? It's going to go into Japanese yen the fastest, and now Japanese yen is setting up for a squeeze. This is still the end of January. So if Japanese yen is squeezing, rates are collapsing, and stocks are hitting our target, maybe we should be selling stocks and buying bonds. All right. So I put that out. So at the end of January, I said, okay, that's it. Time's up. We're selling our stocks and we're buying bonds. That was at the end of January. But for another 2 weeks, the S&P 500 kept making new highs. So the trolls on Twitter are like, haha, JC, you suck, right? You're short stocks, you're buying bonds, and the S&P keeps making new highs. Haha, you suck. And then I'm like, okay, I suck. The S&P might be making new highs, but mid caps are making lower highs. Small caps are making lower highs. Micro caps are making lower highs. Meanwhile, the Russell 2000 is below 169, which those of you, I know there's some of you here on this webinar that have been following me for a few years. Remember, at the end of 2018, we wanted to be short the Russell 2000 as long as we were below 169. That was the level. So here we are returning to the scene of the crime. It worked great last time. Let's do it again. We're shorting small caps. Meanwhile, while they're like, haha, JC, you suck because you're shorting stocks and we're still making new highs. Sure, the S&P 500 was making new highs. The advanced decline line on the New York Stock Exchange, stocks only, of course, was putting in lower highs. The Dow Jones Industrial Average was putting in higher highs. The Dow Jones Transportation Average was putting in lower highs. So the bet that we were, okay, so this is important. So the bull case at this moment in February was that transports would make up the difference and break out to new highs and confirm what the industrials were doing. That's the bullish case. The reason I was like, nope, it's the opposite most likely, is because my bet was that industrials were going to catch down and the transports diverging negatively were the heads up something was wrong. And why did I think that? Because transports were actually breaking down to new lows on a relative basis. So if transports were going to show all this outperformance and catch up, they sure had a funny way of showing it. So again, there were plenty of opportunities to get out of the market. That this is, well, I don't know anything about viruses. Like, I don't know the first thing about viruses. So I didn't know the market was going to crash. I didn't know that we were going to be stuck forever. But obviously the people who did know were acting upon that, and we were analyzing that behavior, and we were acting upon it for ourselves. So here we're looking at the S&P 500 in blue, and then in black, we're looking at the consumer staples relative to the rest of the market inverted. So in other words, so these two charts are moving up and down together. When this black line is moving up, that means consumer staples are underperforming. When the black line is moving down, that means consumer staples are outperforming, right? Because think about it, when no matter how bad things get, we're still going to smoke cigarettes and drink beers and drink Coca-Cola and brush our teeth and wash our dishes. That's not going to change. So when the market is under pressure, stocks are selling off, you're going to see those consumer staples are going to outperform. However, when stocks are doing well, those staples are going to underperform. Hence why these charts are moving together. And we've seen great divergences in the past. Notice how in 2007, as the S&Ps made new highs, consumer staples were outperforming, a key divergence pointing to a collapse in stocks and outperformance in staples. Same thing in 2015, new highs in the S&Ps, relative strength in consumer staples, which led to the correction in 2015 into 2016. Again, most recently, this was in February, higher highs in the S&P, relative strength in staples. Again, was right again. And again, there's no holy grail. I mean, listen, if there's one holy grail, it's probably this one. But there is no holy grail. It's about the weight of the evidence and looking at all of them. So I'm like, okay, here are financials, arguably the most important stock market, most important sector in America, I should say, pressing up and literally closing at a new all-time high above the 07 highs. Finally, after 13 years, financials are going to break out to new all-time highs. But then I'm seeing bonds are suggesting we buy them. Yen is suggesting we buy yen. All of our stock markets are hitting our upside objectives. We're seeing negative rotation. This is not the type of environment where financials are about to break out, right? That doesn't make any sense at all. So let's see what's going on under the hood. Well, with new highs in financials, by the way, these are the 07 highs, right? This is still in February before the crash. These are the 07 highs. And then here we are making new highs. And these are charts taken directly from the presentation I gave on this particular day, just so you guys know, not like cherry picking charts. But I just want to show you the thought process. New highs in financials, new all-time highs. Regional banks are putting lower highs. Momentum in financials are putting lower highs. Financials relative to the rest of the market are making 5-month lows. With all these things going on, is that the type of environment where financials are about to break out of a 13-year base and put in a historic breakout? I don't see it. I don't see it at all. Meanwhile, regional banks were breaking down to new all-time relative lows before the crash. Before the crash. All right, so now let's talk about breadth. Notice we're looking at the 63-day high list in the S&P 500. Some of you might be wondering why 63 days. That's the amount of trading days in a quarter. So with new highs into the S&P 500 into February, and the trolls are like, haha, JC, you suck, right? We saw a fraction of stocks making new highs. Literally half the stocks were making new 63-day highs. Meanwhile, on the way back up, just so you know, on the way back up, what were we seeing? We were seeing an expansion of stocks making new highs. That's breadth expansion is the opposite of what we saw here, which has kept us bullish, the breadth expansion. Same thing in the 21-day high list. Look at the new highs into February in the S&P and a fraction of stocks making new 21-day highs. Some of you might be wondering why 21. Those are the amount of trading days in a month. So ballpark, right? Well, 2020, 21, 22, depending on the month, of course. About 21 days. And then what were we seeing on the way back up into April, May, June? An expansion in new highs. Double the amount of new highs in June than we saw in January. That's breadth expansion. All right. So what do we see today? Today we see that we want to be buying stocks. We still want to be buying stocks. Look at the new all-time highs. I mean, there's a lot more of them, by the way. If I spent all weekend counting the all-time highs, I wouldn't have done anything over the weekend. But just to show you, monthly closing basis, consumer discretionaries, all-time highs, healthcare, communications, staples, materials, industrials, broker dealers, all-time highs. All-time highs, folks. This is, it's not like only 5 stocks are leading the market like the bullshit they've been telling you in the past, right? That was wrong then and it's wrong now. Like, we are seeing breadth expansion, folks. And not only that, we're seeing rotation, market capitalization rotation, not just sector rotation. So let me point this out. So on the y-axis, we're looking at the first quarter drawdown. So in other words, the further up on the chart it is, the better it did in the first quarter, the better it held up during the COVID crash. So obviously the best ones, Nasdaq, Russell Growth, Nasdaq 100, right? Large cap growth did the best in the first quarter. And then look what did the worst, the ones at the bottom. Mid caps, small caps, micro caps. Now on the x-axis, we have the percentage return over the last 3 months. So the further to the right it is, the better it's done the last 3 months. The further to the left it is, the worse it's done the last 3 months. So notice the bifurcation. The worst performing areas in the first quarter are now the best performing areas over the last 3 months. And the best performing areas in the first quarter are now the worst performing areas over the last 3 months. So we're not just seeing sector rotation, we're seeing market capitalization rotation as well. And we're seeing expansion globally. Here's the global Dow Index, which, by the way, is almost 20% financials, and it's breaking out to new all-time highs out of a 3-year base. This is a global index. If global Dow didn't explain that. And by the way, Germany is making new all-time highs. And why does this matter? JC, I trade tech stocks. JC, I trade small caps. Why do I give a damn about what Germany's doing? Because Germany is one of the most important stock market indexes in the world. And we're not going to go much further without Germany at least participating. Doesn't need to be a leader, it needs to participate. And if the world was coming to an end, and all these gloom and doomers, talking about, how the economy and the stock market, they're not, what do they say? They're uncorrelated, that they're dislocated, the economy and the stock market. Like, what are you even talking about? Right? The bottom line is, if they're buying European stocks, the world is not coming to an end, right? If the world's coming to an end, European stocks, and more importantly, European banks, I didn't include the European banks. Oh, damn, I should have included it. European banks are absolutely ripping, right? If the world is coming to an end, European banks are going to be front and center, leading the world, leading the march down to zero. The opposite is happening right now. Meanwhile, from a sector rotation standpoint, we talked about consumer staples in February outperforming, suggesting we need to be selling stocks. Okay, now let's take that thought another process, that thought one step further. Here we're looking at a ratio of consumer discretionary stocks versus consumer staples. What are discretionaries? Where we spend our discretionary income. Autos, home builders, right? Retailers. We talked about staples before. Brushing our teeth, washing our dishes, smoking cigarettes, drinking beers. The ratio between one to the other looks exactly like the S&P 500, and divergences in the past have led to turning points. Well, my point is here that there is no divergence. We're making new all-time highs, confirming all of the other all-time highs we're seeing, both domestically and globally. Now, from an intermarket perspective, if you recall, interest rates breaking down, copper-gold ratio confirming and breaking down, and regional banks versus REITs breaking down, we're confirming that rates were going lower, bonds were going higher. We wanted to buy bonds and sell stocks. Well, what are we seeing now? We're seeing the exact opposite. Regional banks versus REITs breaking out, copper-gold ratio breaking out, and then as of this week, U.S. 10-year yield, this chart's about 2 days old, this is now picking up as well. Some copper gold can understand, right? Copper, global growth, gold more defensive. So that makes sense with rates. Why regional banks versus REITs? Well, first of all, who cares? Because the chart, they look exactly the same. So it doesn't actually matter why. But the real reason why, if rates are going higher, regional banks are going to get a bid, particularly on a relative basis. My fundamental friends tell me the margins increase and whatnot. If the market thinks interest rates are going lower, fixed income investors are not able to get their yield in the bond market, so you're going to get a sympathy bid in the stock market in higher dividend-paying stocks, REITs, obviously real estate investment trusts, being at the top of that high dividend-paying list. So a ratio of regional banks to REITs and a ratio of copper and gold looks exactly like the U.S. 10-year yield. So this is pointing to higher rates, lower bonds. Meanwhile, gold hit our target, right? Those former highs was our target in gold, and now we're stuck below that. So until gold is able to surpass those former highs, it's somebody else's problem. It's not our problem. There's plenty of things to buy instead of sitting in a useless rock. I mean, this is a useless rock. And I'm fine owning the useless rock if I think that I can sell that useless rock to a greater fool at a higher price in the future. And I may or may not be able to do that, but there's no point in being involved in this metal or in anything for that matter that's below overhead supply. In 2011, the market proved that at this price below 2000, there was an overwhelming amount of supply relative to demand. Here we are for the first time in 9 years back to that price, and the market has proven that there is still an overwhelming amount of supply relative to demand. So if and when it does break out to new highs, I will get that little the funny sound on my computer telling me that we're seeing new highs, and I'll know it's time. But until then, it's somebody else's problem. And then what do you know? Bitcoin looks exactly the same. At 10,000, we were bullish Bitcoin. What was the target? The former highs. I mean, you want to talk about two charts that look exactly the same. I mean, come on. Literally look exactly the same. And the idea is the same. As long our target was hit, we took profits. Now it's somebody else's problem, right? And it will be my problem again if and when we break out above those former highs from the late 2017. And how long will that take? I have no idea. It might be tonight. It might be next week. It might be in the second quarter. Maybe it's never. I have no idea. But I'm not going to sit around and wait in an almost useless currency or in a useless rock and just wait for the breakout because I think one day it's going to break out. Because, by the way, I do think both of them break out. I just don't know how long it will take. It could be tonight. It could be never. And it's probably somewhere in between. It's probably not tonight, and it's probably not never. It's probably going to be sometime in the next few months, maybe the next few quarters. That's my bet. And when it happens, then we'll buy it. In the meantime, I like buying stocks. Here's the S&P 500 making new all-time highs. Here's gold making new 6-month lows. Here's bonds making new 9-month lows. One of these is different than the others. I want to be in the good one. And then finally, here are financials. And what are they doing now, right? We're still stuck below those 07 highs, which I think it's important to reiterate. But broker-dealers and exchanges made new all-time monthly closing highs. Guys, this is in the Mount Rushmore of the most important stock market indexes on earth, but I just want to focus. It's the exchanges that are leading this index, not so much the broker-dealers, mostly the exchanges. So I like ICE. I think it goes to 132. It's the exchanges we want to focus on. Also look at the Nasdaq, not like QQQ, but like the company Nasdaq, NDAQ. Look at also, you got ICE, you got Nasdaq, and CME. Look at CME Group also. All right, so today's market, just in review, we're seeing an expansion of stocks making new highs. We're seeing an expansion of countries hitting new highs, and we're seeing an expansion of industry groups hitting new highs. Guys, these are all characteristics of a bull market. Okay, so that's the top-down approach, and I just want to sort of like reiterate what that means to me. Guys, we're doing this analysis no matter what. All that top-down work, we're going to do always. That's where the analysis begins. Now, we construct a series of universes to supplement that top-down work so that it makes it almost impossible for us to miss anything. So let's talk about the 2 to 100 club. Just conceptually, what are we doing? We're looking for the next $100 billion company. So it's a long-only scanner, just as a function of what it is, right? We're buying the strongest stocks. That's what it is. Now, not every sector or industry group for that matter can scale from 2 billion to 100 billion, right? So there are 13 industry groups that we feel fit that criteria: solar, semiconductors, cloud computing, software, right? You know the names, direct to consumer, the types of companies that can scale 50 times over, okay? All right. Medical equipment, of course, internet, of course, Chinese or otherwise, by the way. A little foreshadowing there. Chinese internet, by the way, closed at a new all-time monthly closing high as well. So it's not just a domestic thing. By the way, and when it comes to semiconductors, Taiwan is making new all-time highs as well. So these are global phenomenons in terms of sector strength, not just a U.S. thing. All right. So what are we doing? Just to for those of you who are unaware, small caps are anything under 2 billion, right? Mid caps are anything between 2 billion and 10 billion, and large caps are anything over 10 billion. And depending on who you ask, mega caps can either be 100 billion or 200 billion. It doesn't really matter what we call them. What we're trying to do is we're trying to capture them as they graduate from small cap into mid cap. So this is the sweet spot. We're looking for between $2 and $30 billion market capitalization that we think can be the next $100 billion companies. And by the way, just to reiterate, we're not just blindly buying the stock at 2 billion and waiting to sell it at 100 billion. Like, we're not actually doing that. We're just creating the universe, and then we overlay our technical analysis on top of it. And the idea is to get chunks along the way, right? 50% gain here, 80% gain here, a double, 30%. Like, we don't need to literally get a 50 bagger. It's just the scan that's going to show us stocks that are moving in that direction, right? So that's what the 2 to 100 club is. And then when you ask me, well, JC, what technical overlays? Well, you got to be making new highs, or at least getting close to making new highs, because you're not going to increase market capitalization if you're making new lows, right? So just as a function of what this is, you got to be pressing up against new highs. And then we have our momentum and relative strength scans that really filter for our clients, really the strongest. And then that's when we overlay our technical analysis. So let's go over a couple of case studies. Here's Netflix. This is a household name, fan favorite. And then notice in February of 2009, that's when Netflix broke out and graduated from small cap to mid cap. And, now this is a $240 billion company. So just to show you sort of the progression, and not that you had to buy it in 09 and hold it until this point. I mean, if you did that, kudos to you. That's great. But you don't necessarily have to do that. You could take chunks along the way, right? That's the idea. So that's fine. That's like an old school name. Let's fast forward to this year. Look at Peloton. We started buying this name at 43. This went up to over 130. This was a $12 billion company when it got on our 2 to 100 radar and was more than a triple in a very short period of time. What about Zoom? Again, showing relative strength, positive momentum. Look how this was one of the first stocks in the market to break out to new all-time highs. The relative strength was there. You know what this reminds me of? It reminds me of Whole Foods. If you go back to 9/11, the first stock in the Nasdaq to make new all-time highs after 9/11 was Whole Foods. And then that ended up being a home run after that. And Zoom kind of reminds me of that. It was one of the, I don't know if it was the first one. It was definitely one of the first ones. I know for a fact Whole Foods was the first one out of after 9/11, but this was one of the first ones to break out at $108, went to 500. And just to show you market cap, this was a $30 billion stock that went north of 140. Absolute beast. So these are the names we're looking for, folks. All right, so hot off the presses. This is the latest 2 to 100 club. You'll notice that we also include what countries these are in, mostly because I'm just interested, because I think it's cool. Not because we're going to decide, we need exposure to the Netherlands, or we need more Bermuda exposure, right? Like, it's not because of that. For me, I'm just kind of like a nerd. I'm like, Farfetch, the UK company. All right, that's cool. Right? All right, so that's how I look at that. And then we look at the market capitalization, which is, the more green it is, the closer to 2 billion it is. And then the more blue it is, the closer to 35 billion, which is, where we sort of cap this particular scan. Not that we wouldn't buy a $60 billion company. In fact, we are buying a $60 billion company right now, software stock. It doesn't mean anything. It's just for this particular scan. And then notice how it's sorted by proximity to new 52-week high. So it's interesting. Bill.com, a stock that I like a lot here at the number 2 on the list. All right, so here's a stock on the list that I like. This is Yandex. So this is, I think it's the Google of Russia, as well as some of the neighboring companies. Look at the relative strength breaking out to new highs. This comes straight from the 2 to 100 club, hot off the presses. 68 is that level. This is a $25 billion company. If we're above 68, we want to be long over the next couple of quarters with a target above 100. So this is Yandex coming from the 2 to 100 club. And then if that's something that you're interested in, guys, I encourage you to become a premium member of All-Star Charts. For me, it really truly is a blessing to be able to speak to some of the smartest investors in the world on a daily basis. Like, I mean, literally every day I'm on the phone with these guys. And I say guys because it is mostly guys. I hate to say it. I mean, sometimes, sure, there are some female traders and some female analysts that I'm on the phone with, but it is really guys. I just dropped the link. We normally charge close to $2,500 for this. This is All-Star Charts Premium. And what do you get in All-Star Charts Premium? Well, you're going to get access to our live monthly conference calls. Kind of similar to this. We actually use GoToWebinar as well. And we do this twice a month. Our conference call was actually last night. We do 2 a month, and we just go over. Last night was about 100 charts, which is actually light. Sometimes we're up closer to 150, 160 charts. And all the conference calls are archived there going back 5 years when we first started doing these. Then you also get access to the trade ideas page. So this is, we do a lot of research, a lot of global macro work, all these scans you see. Some people are interested in it, some are not, right? It doesn't, but just because we're doing all the research doesn't mean you have to read it. If you want to read it, absolutely read it. I want you to read it. But if you don't care about that and you're just like, all right, JC, I don't care about Lithuania. I don't care about oat futures price in Japanese yen or whatever it is that we're talking about. Like, if you don't care about that, fine, just go straight to the trade ideas page. And then, of course, you get access to the bi-weekly 2 to 100 club report, which, like I said, we're not supposed to talk about, our favorite kids here. We're supposed to love them all exactly the same. But I really do like the 2 to 100 club a lot. And then, of course, you can get access to myself and the rest of the team if you ever have any questions. So you're going to get access to 2 to 100 club, the trade ideas page, the live monthly conference calls, and all the premium research that we're doing. Go to allstarcharts.com/TradeThirsty, and I just dropped the link. Take advantage. I mean, this is a huge discount. And then just so you know, we're going to be raising prices next year because we have a lot new. We just hired a couple of new analysts. We have more scans that we're about and tools that we're about to release. So we'll be raising that. And just so you know, if you lock in the $1,500 price, you are grandfathered in for life, no matter how expensive the premium research gets. So that's allstarcharts.com/thirsty. Okay. So, all right, let's talk about some of the other universes, right? So we talked about the top-down approach, and then we talked about the importance of supplementing that top-down work with our bottoms-up research to make sure we can't like make it impossible for us to miss anything, but we want to make it really, really hard for us to miss anything. So another universe we have to supplement the 2 to 100 club, also part of the premium subscription with All-Star Charts, is the Under the Hood report. And what are we doing with Under the Hood? We're building a universe of stocks, right, that is showing an unusual increase in investor interest. It might be insider buying transactions. It might be high volume. It might be an unusual increase in mentions in social media. It could be all sorts of unusual options activity, all sorts of stuff. So this Under the Hood just dropped 2 days ago. Here, what we do is we create the report. And what I like about this particular report that comes with All-Star Charts Premium, guys. So I just dropped the link. Make sure, I'll just drop it in here for you guys. All right, so we create the list, and this one in particular, so the 2 to 100 club is long only, right? We're looking for the next $100 billion companies, right? We're not going to get there by shorting it. But in the Under the Hood, we're just seeing that a bunch of lunatics are now paying more attention to these stocks than they were before. It could be long or it could be short, which is what I like. So here's one from this week's Under the Hood report, Autodesk, ADSK. This is a $60 billion software stock. So this is on the 2 to 100 list. It's not on our 2 to 100 like published list because it's 60 billion and not below 35, which is the threshold. But it doesn't mean we can't buy it, right? This is where the top-down approach and the bottoms-up approach really combine together. So Autodesk, if we're above 265, I like it long. I like the relative strength, and I think we go to 350. That's a nice trade idea from the Autodesk. All right. What are the Young Aristocrats? This is another report sent out every month that comes for anybody who signs up for All-Star Charts Premium. Let me just drop the link here in the chat. This is for All-Star Charts Premium. And if you sign up for this, you're also going to get this once a month. What are the Young Aristocrats? Well, an aristocrat is a stock that has raised its dividend every year for 25 consecutive years, right? So think like Johnson & Johnson, Coca-Cola. They've raised their dividends every year for over 60 years in a row. So what we're looking for is the future aristocrats. We're looking for the stocks that have increased their dividends every year for between 5 and 9 years. And then, of course, pushing up against new highs. And then here's a great stock from this list, Lakeland Financial. You can see it right here. It's raised their dividends for 8 consecutive years, currently pays a 2.71 yield, and the payout ratio is 37%, so very low payout ratio. My fundamental friends tell me that that is great. $50, that's the level. If we're above 50, we want to be long Lakeland Financial, LKFN, with a target near 62. And those are the monthly Young Aristocrats. So with the All-Star Charts Premium. Go to allstarcharts.com/allstarcharts.com/thirsty and sign up now. And you're going to get access to the Young Aristocrats that I just showed you. You're going to get access to the Under the Hood report. Of course, you're going to get access to the 2 to 100 club. These are the stocks that we think are the next $100 billion companies. All the next $100 billion companies are going to come from that list, right? It's just math. They got to go through there. And then, of course, you get to contact myself and the team anytime you'd like. This is a $2,400 value that you're getting for $1,500, all right? And it's risk-free. So what does that mean, risk-free? That means that you have 30 days. No matter what, if you hate it or you hate me or you think it's just not for you, just email us back and we'll send you a full refund. No questions asked, all good. So this is a risk-free trial to All-Star Charts Premium, and go to allstarcharts.com/thirsty and sign up right now. All right, so I promised you a free trade idea. I've given you a few. I've given you a few more than a free one. A few free ones from the Young Aristocrats, from the Under the Hood report, from the 2 to 100. Here's another one from the 2 to 100. I really like this one, guys. This is Bill.com. We use it internally. We just hired a new controller at the firm, and this is we immediately got a Bill.com. I don't know how much they're charging me for it, but if you are a business owner, my understanding is this is great. We have some international employees as well, so this has been particularly helpful. Sorry to get so fundamental on you. The bottom line is it's on the 2 to 100 club. I think this baby goes a lot higher for sure. And most importantly, the risk versus reward is in our favor, very much so. This is a $10 billion software company. 122 is the level there. If we're above 122, I like this long with a price target of 180. That's Bill.com, B-I-L-L. And then I'll just leave this up here. Michael wants to know about the guarantee. So it's a money-back guarantee, to be clear. So it's a 30-day money-back guarantee. Go to allstarcharts.com/thirsty, and you have 30 days. And if for any reason before then you decide it's not for you, no questions asked, money back guaranteed, happy to refund you. You don't even need to tell us what you don't like about it. But we're that confident that you are going to love it, and you are not going to be able to enter a trading week without the confidence of what we're bringing to the table, because not only are you getting the global macro work, not only are you getting the risk management to be like, hey guys, we should probably get out of the market because bonds are saying that, this is a problem. Not only are you getting all that, but you get to access myself and the rest of the analysts regularly, anytime you want. Anytime you have any questions about the market, something about how we analyze momentum or relative strength or whatever it is, we're always around. So, just think about how much confidence you'll have going into the market, knowing you have not just me, but an entire team behind you, right? It's a whole team. We're in this together. We're here navigating these markets together every single day. All right. So let's see. What other questions do we have? JC, how often does the 2 to 100 club come out? All right. So that's a good question. So the 2 to 100 club comes out every 2 weeks. Just dropped today, and we'll drop 2 Wednesdays from now. So every 2 weeks, we get the 2 to 100 club. And the reason it's every 2 weeks is because the list itself is not going to change that much. Right? There'll be some changes every couple of weeks, but not that much. The Under the Hood report, on the other hand, that comes out every Monday, usually Sundays. And these are the stocks that are showing an unusual increase in investor interest. And they're going to come out on Mondays. And then the Young Aristocrats come out every month, once a month for the Young Aristocrats. And we got a couple of new scans too. I don't want to let the cat out of the bag just yet, but we got a couple of new interesting scans. And this is in addition to all that top-down work that we're doing. And when we can combine them both, I think that's the real magic. So, guys, allstarcharts.com/thirsty. I mean, this is a $2,500 package. You're getting it for $1,500. You're getting 2 live monthly conference calls, an hour each, with over 100 charts, sometimes over 150 charts. The trade ideas page, the Under the Hood report, 2 to 100 club, the Young Aristocrats, and then unlimited access to myself and the rest of the team. So, all right, Angie says DAX. She's happy about the DAX. All right, rock and roll. JC, where are you from with that accent? I am from Miami. My family came from Cuba in the early 1960s. When I graduated high school, when I was 18, I moved to New York. I graduated from Fairfield University, where I played baseball. Can you imagine a Cuban from Miami playing baseball? Can you imagine that? So I fit the bill pretty good. I got into a school that my grades probably wouldn't have got me, or definitely, I should say, wouldn't have gotten me. Not that I had bad grades, but Fairfield's a really good school, tough school to get into. And Fairfield University, for those of you who don't know, is in Fairfield, Connecticut County, which is where Greenwich, Connecticut is, which is the ground zero of hedge funds around the world. So I was strategically placed to take advantage of those opportunities. I started working on Wall Street in 2003, and the rest is history. I mean, wow, what an amazing opportunity I had to live in New York City for so long. I ended up moving to California when I was in 2015, 5 years ago, when I was 33 years old. Spent 5 years out in California. That was pretty amazing, and now I'm back here on the East Coast. So that's the deal with me. So, guys, allstarcharts.com/thirsty. They're asking, how long is it going to be up? I don't know the answer to that. Sorry. The TradeThirsty folks, the good folks here, just invited me on to talk about, the stocks that I'm looking at, kind of show off my new scan. They love the 2 to 100 list. I mean, I feel like everybody does. I love it as well. So I figured just show that off, but I'm not really sure what the plan is. So sorry about that. More importantly, what's my favorite wine? Whoa. Oh, I don't know. I mean, so, as I mentioned earlier, if you were late to the webinar, I'm a certified sommelier. I'm also a French wine scholar, and I am also a certified Japanese sake advisor. So needless to say, as my wife likes to say, I think you just like taking tests. But for me, my favorite wine, I mean, it depends what we're doing. What time of the day is it? Who are we with? What are we eating? Like if I'm eating oysters, I'm going to have a Muscadet. If it's Thanksgiving, I'm going to have Pinot Noir, right? If I'm having, a nice steak, what kind of steak? Is it a ribeye? If it's something ribeye, maybe I want a Gamay or a Pinot Noir high acid, where the California cab might be a little overwhelming. Or maybe if it's a T-bone or a strip, something a little leaner maybe, then we'll go maybe with that California cab. But I'm more partial to the old world. I'd probably go Bordeaux, left bank Bordeaux. I really like the Italian stuff, right? Brunello, Barolo, right? I like all that stuff. So for me, wine is an academic endeavor. I'm pretty deep into Australia these days in the Barossa Valley. So that's what I got cooking. But that's on me. Nebbiolo, yeah, no doubt about it, baby. Yeah, that Nebbiolo, get that Barolo, the Barbaresco is beautiful, beautiful. Michael says, very intelligent and enthusiastic presentation. Wow, that's very nice of you. Thank you very much. JC, when you say you like a stock, Bill.com above 122, do you use stops? And if it's not working, where do you set them? Yeah, listen, if you don't want to get whipsawed, the only way to guarantee to avoid whipsaws is to stop trading altogether, right? That's what I've learned. So we want to buy it above 122. If it breaks below that, we'll have a stop below that. I like to keep it maybe not 122 even, maybe a quarter, 50 cents below that. But I'm okay keeping a tight stop because I do this for a living. So if we get back above our risk level, I can buy it back, right? I have to be willing to do that, and I am willing to do that. Now, if you maybe are an engineer or a school teacher or a doctor, whatever it is that you're doing, and you're just not in front of the computer all day, maybe you want to adjust your position size accordingly, smaller position size, keep the stop further away, less likelihood of getting whipsawed, right? Less likelihood of getting stopped out, but you still get in the position. For myself, that I know that I'm going to get stopped out if we break a level, I also know that I'm going to get back in. I can be very aggressive and have larger positions. So I would say, depending on your lifestyle, depending on what you do for work, you can adjust your position sizing and your stop placement accordingly. So I hope that answers your question. John wants to know, do I miss In-N-Out Burger? When I first moved to California, I was like, yes, In-N-Out Burger. I got to tell you, the only real time that I really enjoyed it, I was pretty banged up. It was after a concert, and I didn't have dinner. It was a Chris Cornell concert, rest in peace. And, we were pretty banged up, and we went to In-N-Out Burger, and that may have been the best burger I've ever had in my life. But, without a few beers or wine, I mean, the In-N-Out, I'm just not into the fast food and stuff like that. But good question, John. Good question. Listen, guys, I could sit here doing this all day. We could talk about wine. We could talk about cheese. We could talk about sake. We could do all that stuff. We actually do that stuff. I like to pair my conference calls with some wine sometimes. Anything on my mind. If I'm trying something new, I like to share, with our audience. So You know, guys, I think this is a great opportunity. The good folks at TradeThirsty brought this on, you know, invited me over, and I just want to give a huge shout out to everybody over there. Jeanette Sims, what's up? Thank you for inviting me. And then just, you know, like I said, take advantage. Let me just drop this in. I'll just drop this in one last time, just so you guys got that. Just go ahead and click on that, and that'll take you allstarcharts.com/thirsty. David wants to know what trading software I use. I use Koifin. Full disclosure, I'm also an investor, a private investor in Koifin, and I also use Optuma, Optuma. So that's what I use. John's heading to In-N-Out Burger now. Good luck with that afterwards. All right, so I guess that's all the questions. All right, everybody, listen, from the bottom of my heart, I appreciate everybody being here. I hope maybe you learned a couple of things. Maybe I inspired you to maybe look at a chart or two that maybe wasn't on your radar before. You know, that's the very least of it. If I can add some value, that's great. And if you like what we have to say, you want to see some more, I encourage you, check out the risk-free trial at allstarcharts.com/thirsty. Thanks, everybody.